Imagine a silent trader that never sleeps. It scans millions of data points at 3 a.m., digests the morning's headlines in seconds, and decides, in a fraction of a second, whether to buy, sell, or sit tight. No ego, no moods, just algorithms, probabilities, and a cold, relentless hunger for edges. This is the world of algorithmic trading bots, where machine learning, news sentiment, and 1,000 tiny signals collide to chase market alpha. Today, we pull back the curtain. You'll hear how these bots actually forecast markets, the data they drink, the models that digest it, the backtests that seduce traders, and the very real risks hiding behind glamorous returns. By the end of this segment, you'll understand why a bot that looks flawless on paper can implode in live trading, and what separates a robust system from a beautifully overfitted mirage. Let's begin. The first secret to any trading bot is its inputs. Think of inputs as the bot's senses, raw information it uses to form a view. Price history, the simplest and most powerful input. Every tick, minute, hour, and day writes a new line in the bot's memory. Bots use this to compute momentum, volatility, support, and resistance, and so on. News sentiment. Words matter. Modern bots parse headlines, earnings reports, tweets, and regulatory filings to measure positive or negative sentiment in real time. A single sharp headline can spike short-term volatility. The bot's job is to detect whether that spike is noise or a trend starter. Macro indicators, interest rates, unemployment, GDP revisions. These are the slow-moving tides that alter the probability landscape for entire sectors. Alternative data, satellite images of parking lots, credit card flows, shipping manifests, web traffic, and even Google search trends. The edge often hides where everyone else isn't looking. A practical trading bot blends all of these. It doesn't rely on a single signal. It builds a probabilistic mosaic where each data piece nudges the overall prediction. Now the models, the engines under the hood. At one end, you have simple algorithms, moving averages, rule-based systems, mean reversion triggers. They're transparent, fast, and easy to backtest. At the other end sit complex ML architectures, LSTM networks that remember sequences, transformer models that handle long-range dependencies, and ensemble systems that stitch multiple models together. Here's how to think about them. Rule-based systems are like a seasoned trader's checklist. If A and B happen, then execute C. They are explainable, low latency, and robust to noise, but limited in capturing non-linear patterns. LSTM and recurrent models excel at sequence data, price series, candle patterns. They can capture temporal dynamics, but require careful tuning and lots of data. Transformer models, the architecture behind modern language models, are surprisingly strong at financial time series when adapted properly. They can weigh disparate inputs, price, news, indicators, and model complex relationships. Ensembles combine different approaches, say a transformer for macro signals, an LSTM for intraday price rhythm, and a rules engine for risk triggers, producing a more stable forecast than any single model. But models are only as good as the data pipeline and the training regime. Garbage in, garbage out. This brings us to the seduction of backtesting. A slick backtest shows a green equity curve climbing steadily, low drawdowns, and a jaw-dropping sharp ratio. It feels like proof that the bot has cracked the market. But backtesting is a minefield of traps. Data snooping, when you try too many strategies on the same dataset until one looks great. That great result might be pure chance, overfitting. The model learns the noise, not the signal. It will perfectly predict the past and utterly fail in live markets. Survivorship bias, testing only on companies that survived or indices that exist today, ignores the failures that would have tanked returns. Look ahead. Bias and latency assumptions. Did your backtest assume you had access to data you wouldn't have had in real time? Did it ignore market impact and slippage? A responsible backtest reports not only mean returns, but the distribution of outcomes, the worst drawdowns, and stress scenarios. It asks, how brittle is this system when volatility doubles? If you can't answer that, your backtest is a sales demo, not a test. Risk management is the quiet hero. You can't talk about trading bots without talking about position sizing, stop-loss rules, correlation controls, and maximum drawdown caps. Here are the core disciplines. Position sizing ties the bot's aggressiveness to portfolio risk. A shaky signal should buy less, high conviction should buy more, but always within a ceiling. Stop-loss and take-profit logic prevents a single signal from wiping a big chunk of capital during an adverse event. Correlation controls avoid concentrated bets that look diversified on paper but move together under stress. Real-time monitoring and circuit breakers allow human operators to pause or override algorithms when markets act in unanticipated ways. Even the best predictive model fails without ironclad risk protocols. So how do retail traders fit into this landscape? Today's retail ecosystem gives individuals unprecedented access to bot technologies, cloud platforms, user-friendly APIs, pre-built models, and inexpensive compute. DIY trend followers use simple moving averages and breakout logic with automated execution, low complexity, low latency, easy to deploy. No-code platforms let traders drag and drop models, plug in data feeds, and run backtests. Great for prototyping, but beware of default parameters and overfitting traps. Manipulation risks. Trading patterns that artificially move prices are illegal. Ensure strategies don't create manipulative loops. Best execution and fairness. For funds and managed accounts, demonstrate best execution practices and avoid conflicts of interest. Model explainability. Regulators increasingly demand explainable models for decisions affecting clients. Keep feature importance reports and rationales. Record keeping. Maintain immutable logs of strategy versions, data snapshots, and order execution for audits. Privacy and data use. Using alternative data often requires contracts and consent. Avoid unlicensed personal data. Compliance reviews include legal and compliance in your deployment pipeline. Automated trades should pass pre-deployment sign-offs. Final playbook. A quick operational checklist before you go live. Data pipelines validated and versioned. Backtests include slippage, fees, and market impact. Walk forward CV and Monte Carlo stress tests passed. Paper trading and shadow mode for 4 to 12 weeks with acceptable metrics. Risk limits, position sizing, daily loss cap, max drawdown, enforced with hard stops. Canary deployment plan and rollback procedures in place. Monitoring dashboard with drift detection and automated alerts. Compliance sign-off and audit trail enabled. Kill switch and human override tested. Post-deployment retrain/retire policy documented.